Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. Charles, thanks so much for taking the time today to have a bit of a discussion with about one of the dispositions you've just recently had in your portfolio, McDonald's. It was, always interesting when you see such a behemoth of a company and a great company and a company that seems to be, doing the right thing, day in and day out. The actual product, from a nutrition standpoint, that's somewhat questionable, but those are personal views than anything. But from an investment standpoint, it's always interesting, or at least I find it interesting, when you come across a point where you determine it's time to sell the company. I'm always interested as to what the rationale is and where that comes from, because there's got to be, sometimes there needs to be an exit point, and you have to recognize that exit point. Proper investing is buy low, sell high, and if you don't end up on the sell side, it's all sort of a potential gain. But when you actually sell, it's a real gain. So I just wanted to talk a little bit about that. So I'll just pass things over to you, and maybe you can just give us an update on why you decided to sell McDonald's.
Well, we know that we've been in a low interest rate environment for a few years now. So when you get investors around the world, they're looking for yield. So they're always trying to find higher dividends and higher yield. And they're finding it in the U.S. market. So whether they're Europeans or Japanese, they're putting money into the European market. And what they're buying, and they've been buying utilities and they've been buying telcos in the States and consumer staples because the dividends have been very high. The yields are twice as high as the 30-year bond. So, for example, the yield on McDonald's is over 3%. So people are so hungry for yield that they're chasing yield and causing the companies, the stock price, to go up as the yield goes down as they keep moving into it. So when we look at McDonald's, yes, McDonald's is a great company, but just in the last, it hit a new high in March of 2016, and it's very expensive. Well, not very expensive, but it's expensive by the way that we look at it, and we know how we look at it. We look at economic book value, which are the real numbers, instead of what the company's projecting that earnings might be down the road. So we're looking at the expectations as are as high as they've ever been for McDonald's. And we know the catalyst is money pouring into these kind of companies. So as interest rates start going up, because the demand for money will go up as the economy picks up, we're going to be seeing companies and institutions selling these overpriced stocks and moving into other yields, whether it be bond yields or whether it be junk bond yields or whatever. So there's a lot of pressure on the upside to move the companies because of yield, and there will be downside pressure coming shortly with interest rates moving up. So yes, we like McDonald's, and obviously we like the companies, but as we always say, it's about 80% price. So when the valuations get high, we might wind up in McDonald's down the road, but it would be at a much lower price than it is now.
Yeah, well, that makes sense. There's got to be a point at which the price doesn't justify what the value of the company really is doing. And when you look at that gift horse in the mouth and say, well, this is something that we're probably not going to see because the company, from what I'm hearing you say, it's the ability for it to continue at for the ability for it to justify its price, it's just not realistic. So,
No, and as we know, companies don't grow to the moon.
Right.
So companies become favorable and companies become out of favor. And what we always say is that I'm not looking at McDonald's and making a comment on what McDonald's expansion is going to be in earnings growth over the next 5 years, and then saying is the stock price warranted. What I'm looking at is what the market says the stock is worth, and look at what the company's actually doing and what they would have to do to meet that price. So that's why we sell.
Yeah, I know, it makes sense. And, as you say, it may come to a point where you acquire it again in the future when it's a justified time to do so. Great companies, you sometimes have to let them go when you've got an overvaluation or a price that's much higher than it should be. You just can't ignore that. And that's and that's what I find interesting. I find when some people look at their portfolios, there's a certain emotional attachment that they may get with their portfolio. Maybe they've held a certain company for a long, long time. But if you're not analyzing the fundamentals and the metrics and the numbers of the company like you are on a regular basis, that emotion may keep you in something that just you shouldn't be in. And so keeping that emotion away through the metrics that you use and the analysis that you use, I think makes sense, because it's when you're being hired as an investment counselor and you're being hired to return to a client more than they gave you, you can't let emotion creep into the decision-making process. It really does need to be based on the metrics and the analysis and the deep dive number crunching that you do.
That's the most important aspect. If you ask whether it be Buffett or whether it be anybody who's considered Hall of Famer, it's always about the price.
Well, again, thanks so much for taking the time just to sort of explain the rationale behind the sell that you did on McDonald's, and yeah, I look forward to sort of talking to you about what you did with those proceeds. Now that when you realize some proceeds from a sell in the portfolio, that means that cash needs to get deployed at some point into something new. So I look forward to talking to you further on our next call about what you did with the proceeds and what new security showed up in the portfolio. Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.